but buying quality is a key part of investing in the stock market and really having that long-term growth. Family. And for those of you that are new to the channel, welcome. We're excited to have you here. I'm Kevin Tenderson. I'm the co-founder of Flex Financial Trading Group, and we teach people how to build wealth and create financial freedom in the stock market by using our proven system, the Flex Financial approach. So again, we're excited for the topic today, where I'm going to be covering 3 ways to go broke in the stock market. And if you can avoid these, then you'll be much better and have a lot more success in your endeavors in the stock market. But before I jump in, make sure you click that like button below. Also subscribe. Make sure you can keep up to date with all the new content that comes out. Jumping right in, the number one thing you can do to go broke in the stock market is putting all of your money into one stock. And this goes without saying, you definitely don't want to put all your eggs in one basket when it comes to pretty much anything, but definitely not in the stock market. There's a lot of great companies out there. I hear, people talking about Amazon, Tesla, Google, some of the blue chip stocks out there, some of the ones that have some exciting growth, seem to have some huge explosive growth at times, and people want to, take full advantage of that and put all their money into one stock. But you definitely want to avoid doing that. There's a few things that can happen when you do that. One is the emotion of the stock market. So a lot of times when you have money in a stock, or you have a lot of money in a stock, unfortunately, the stock market and individual stocks do not just rise in a steady line up. There's times where stocks pull back. There's times where institutions profit take, where they take profits and the stock price will go down. There's times where bad news comes out. There's times where earnings don't quite hit. So there's a lot of things that can happen within the stock market that might drive the price of a stock down. And emotionally, that can be very difficult to hold on to a stock when the stock drops and has a large pullback, especially if you're only holding one stock. So your whole portfolio is going to drop when that happens. So other things, also when you're only in one stock, you're not taking advantage of other industries, other verticals, different things that can go on in the stock market and also help your account grow. And then if for some reason something happens to that company and it starts turning down, having a negative impact on something happens that negatively impacts the company, top line revenue starts to dip, institutional money starts to come out of that stock, you don't know if it'll come back, then your whole portfolio being tied to one stock can be a big problem and can cause some real issues for you. So one thing you want to do, or the fix that we can have for this, is definitely you want to diversify. You want to have at least 3 to 4 stocks if you're starting out. If you have a smaller account, 5, 10, 20,000, and then as you grow, you can start to invest in multiple stocks. I hear a lot that people do suggest going with 15 to 20 stocks, but depending on your account size, that may put you in a situation where you're too thin in certain areas, or just stretched too thin across all the different stocks that you're investing in. So I would say pick 3 to 4 solid companies that you really like, that you really understand, and that you want to invest in, buy quality, and that'll help you out with that. Also, what we like to do is we teach people to look at the Dow and dividend paying stocks. The Dow is going to be 30 of the top traded companies, and they also are proven companies, and most of them pay dividends. So that's going to do a few things for you. That's going to give you some additional security as you're investing in solid companies. Also, when a company pays a dividend, when the market pulls back, since those companies pay dividends, institutional investors tend to hold on to them so they don't dip as much in pullbacks. And also, when the market retraces and hits new highs, dividend paying stocks usually are the ones kind of leading that way, and they rise faster. And they're people that are investing in them tend to take benefit in that. So definitely add some Dow dividend stocks to your portfolio. And then lastly, growth stocks. So there are some exciting companies out there that are growth stocks that you can invest in. Make sure you're doing your due diligence. Make sure you understand the company. Make sure they have that top line revenue. Make sure that they're solid. But these companies will allow you to diversify a little bit, maybe get you into another vertical, another industry. And then growth stocks do just what they're intended to do. These companies have an advantage, so they usually tend to grow a little bit faster. And then by you investing in them, your account will grow faster as well. So we definitely want to diversify. We want to have at least 3 to 4 solid companies that we're investing in. Get some Dow, get some growth stocks, and that will help you out with keeping, from putting all your eggs in one basket and allow your account to grow. All right, so number 2 thing that you can do to go broke in the stock market, and that's trying to get rich and what I call gambling in the stock market. So for some reason, there's this idea, and I've seen many people, people that are successful. They have great companies, they have great jobs, they make a lot of money. But when it comes to the stock market, for some reason, they see it as a casino. They see it as a place to gamble. They see it as a place where they can just take some risk and throw some money at something. Maybe they got a tip from somebody. Maybe they heard this is a new hot stock and they want to put all their money in there and get rich overnight. And unfortunately, the stock market doesn't work that way consistently. You can make some money. There are people getting lucky here and there, and they're hitting on some things when they just have a hunch and they throw some money in, but that's not going to consistently make you profits, and it's definitely not going to help you build wealth over the long term. So what we need to do is kind of change our mindset, and then also we need to kind of move towards a long-term investing approach. So one of the things in the stock market is you can day trade. There's tons of day traders out there and they're very successful and you actually can do pretty well. But day trading will be more on the lines of making income. You can make some daily income, monthly income. Maybe you kind of get out of that living paycheck to paycheck. But if you really want to build wealth and start building that financial freedom, then you need to start getting into some stocks that are going to triple, quadruple. And some stocks we've invested in have even gone 7 times or 700% from where we started in a 3 to 5 year period. So if you have your money in something like that and you're letting it grow over time, you can really start to do some damage and really start to build some wealth. So that's one of the things that you want to do in terms of getting out of that gambling situation, is to kind of change your mindset and really get out of that. I'm trying to just throw some money at something really quick and get rich overnight. You got to have more of a long-term approach, really understand the companies that you're in. Again, start to understand how that company is making money, how they make money in the future, and how your assets can grow along with that company. Again, what I touched on, number one, Dow dividend stocks are great to invest in long term. Growth stocks that are solid, have solid fundamentals, also a great way to grow over time. All right, so the number three thing you can do to go broke in the stock market is going with your gut or following the hype. So this kind of touches on number two a little bit when you're doing that gambling, but this takes it a little bit further. You haven't done any research. You like a company, maybe they put out a product that you really like, or you heard from a friend that it's a good company, or you're going online and you're reading about the new next big thing, the new Amazon, the new Google, something like that, and you have a hunch that it's gonna be great, you're gonna make a lot of money. But what happens when you throw a lot of money at it? It doesn't quite do what you expect. It doesn't have the top line revenue to kind of sustain any long-term growth. It doesn't have any institutional money funneling in because they're not actually making money or being profitable. So then you end up either losing money or you get into a waiting game. And you can be using that money that you're investing into those stocks that may have potential to grow into stocks that actually are already profitable, already are successful, and you can have gains in those stocks. They may be a little bit more expensive, but buying quality is a key part of investing in the stock market and really having that long-term growth. Another thing that you can do is to research. So you want to research stocks. You want to understand how these companies make money. You want to understand, what their industry, how they fit into their industry, if they have any advantages, if they have any products that are, beating their competition. Next, you want to understand the charts, short term, long term. So you want to see what that company is doing in the short term. You want to see in the long term that it's had the ability to navigate whatever's going on, whether it be COVID or anything else like that, and have the ability to retrace and hit new highs. You also want to understand the top line revenue. So with these companies, you want to see that top line revenue continuing to grow. And that's really going to dictate how the stock price goes. So if a company is continuing to add to their top line revenue, it's going to continue to drive that stock price higher. And then another thing you would like to know is you want to understand earnings. You want to be able to get in, read those earning reports, understand what's going on, understand the different divisions within the company, see where they're gaining, see where they're falling, understand what the outlook is for the upcoming quarters, and you can kind of start to get in and understand how that company is going to continue to grow, or if it's not going to continue to grow. And then lastly, something I think you should really think about is having a passion for the companies that you're investing in. That's going to make you want to look at the charts. It's going to make you want to understand the long-term trends. It's going to want you to, make you want to look at those earnings reports and dig in and kind of get a good understanding of what's going on, how they're innovating, if they're going to be going into new markets, how they can kind of navigate this digital economy. So a bunch of things there. And if you have the passion for it, that's going to make you stay tuned in and make you, keep an eye on what's going on with those companies. So that'll go ahead and wrap it up for all the top 3 things that you can do to lose money in the stock market. And again, we're teaching you these things because we want you to be successful and stay away from those things. So again, make sure you go ahead and click that like button below if you like the information here. Also subscribe. You can stay tuned in for our upcoming content. We should be having videos coming out, a couple coming out every week. If you need a coach or a mentor, or just want some help in this game, more understanding, definitely check us out at flexfinancialtg.com. I'll add the link down there in the description, so you can come check us out anytime. We'd love to help you out. And thanks again for watching. We'll see you on the next one.